The Federal Reserve has raised interest rates in response to unprecedented levels of inflation to which they contributed by printing too much money. We've covered the Federal Reserve's role in the current economic climate and how their decisions have affected today's market in many previous videos. So today, we will touch more on this together with David Hunter, a chief macro strategist at Contrarian Macro Advisors. Investment professional David Hunter recently explained the Fed's shortcomings, which have led to the suffering of consumers. If you don't believe the Fed is to blame, stick around until the end as David Hunter examines where they went wrong. Before we get on with the video, we'd like to thank you guys for your continued support for our channel.
It's a mixed bag for sure. The Fed's got a tough job on their hands. We had inflation break out in the last year to levels we haven't seen in 40 years. They kind of slow walked it initially and thought it was transitory. So all of a sudden in January, when it really started heating up, they had to play catch up, and they've been playing catch up ever since. I have probably a little bit different view than a lot of people, and I've been a Fed watcher for all of my 49-year career, and I've seen all the various Fed makeups, through that time, and Fed chairman. I've had a mixed review on Powell over his time here in the chair. Back in 2018, I was really critical of him. He was fairly early on in that role, and he made some blunders, and the market sold off because of some of that. But more than that, it was showing that his inexperience at that time. Fast forward to March of 2020, and he stepped right up to the plate and did the job he had to do to save the system when we're shutting down the entire economy. So I gave him plaudits for acting quickly and decisively. You're not going to be perfect when you're in that kind of environment, but he did a good job. And then now, certainly these last few months, I fear he's doing what he has to do in terms of you can't ignore the inflation. You've got to tighten. So I agree with all that. But some of his rhetoric and their kind of long runway for tightening and things, I think is showing that he does not really understand the magnitude of the risk that is out there. I feel they are over tightening. And frankly, it's funny to say that because they really are. They've only hiked a few times. They're still way under what the market is in terms of market rates. But the market did the tightening for him, and I'm not sure he understands that.
In this first clip, David Hunter briefly touched on his opinion about the Federal Reserve. He recalls a time when he was very critical of Fed Chair Jerome Powell. However, he does mention that Powell did an excellent job of curbing inflation with his actions in March of 2022. David Hunter states that Powell and the Fed do not understand the risk of crashing the economy and adds that they may be over-tightening with their interest hikes.
I do think they should pivot fairly soon. Whether a pivot means just a pause in the rate hikes after we get through July, or whether he's going to take longer to recognize the need to pause and the need to pivot, is hard to say. But frankly, I think the economy is rolling over. There's a lot of things I look at that it's not that you're going to see it immediately in the GDP number or every economic data point that comes out is going to be negative. But in general, we're seeing the things that lead to a pretty sharp downturn. And I'm not sure, again, the Fed is doing enough forward looking. I think they're so caught in looking at the present and looking backwards based on looking at data, which is telling you what happened last month, that I think they're going to end up being, as they almost always are, late in recognizing the need to shift. And so, on that basis, I'd say he's back in my doghouse in terms of still learning on the job.
David Hunter says that he hopes that the Fed pauses interest rate hikes soon. He also states that the Fed has to start looking forward toward the future instead of looking back in the past. To further understand the effects of the Fed's policies, David Hunter analyzes them in the next clip.
First of all, the reason I say the bond market has done a lot of the tightening for the Fed and did most of it prior to their first hike back in April is because you had a 200 basis point jump in rates in a very short period of time, just a few months' time. So you went from extremely low rates to 200 basis points up on that low base was a huge jump, historic jump.
Right.
That's already showing up in terms of housing is rolling over. It's showing up in terms of retail sales and the inventory build that we're seeing in retail. It's showing up in consumer confidence or consumer sentiment. The Michigan consumer sentiment is the lowest that series has ever been, I think. Those are all signs that even though it's still historically low rates, when you have that magnitude of a change in a short time, it's that rate of change in the rate that can have a dramatic impact. I mean, simply put, a mortgage rate that was 2 3/4 is all of a sudden 6%.
Right.
That's a huge change for home buyers, and it really shut down activity. And maybe as important, or maybe more important, it shut down refi activity. For a long time, with rates so low, there was the ability for homeowners to refi, pull money out of their home, and have spending power that didn't mean they were building their credit card balances up. And because their home prices were going up, they said, hey, I'm just taking some of the equity out of my house to do things. And now with rates where they are, there's hardly any and probably no refi activity at all. That's a
Right.
huge drain of liquidity that had previously helped the economy. So those are the things I mean. And then the other tightening really isn't the bond market. It's the big run up in gasoline prices and home heating oil prices. So that was another tax on consumers that really the Fed has to account for, because it does take money out of the consumer's pocket, and money that might have otherwise gone to going out to dinner, buying new furniture, what have you. People are saying, I'm just getting by. I'm doing what I can to get by. And frankly, with the run up in credit card balances of late, I think they're not even getting by. They're finding they have to, they've drained their savings. Savings is down at sharply lower levels than it was the last couple of years. And now they're turning to their credit cards because it's costing, the cost of living's gone up so fast. So while I understand the Fed's focus on that cost of living and saying we got to get inflation down, it's hitting the consumer, they also have to realize the other aspects of what that cost of living has done. We're going to see, their whole goal is to basically have demand destruction and bring inflation down. That's the way the Fed can control inflation or have any impact on inflation. But they have to understand that you're going to see maybe a lot more demand destruction than you're counting on. And by the time you see it, if you wait for that, you've gone way past the time when you can turn this thing back up and have a soft landing. So that's the crux of the problem. Is I think the Fed is at risk of creating a hard landing here because, as I say, they don't really understand the leads and lags to their policy.
Right.
When you see them operating on the basis of a consumer price index that jumped up to 9% last week or a couple weeks ago, and they're making a determination on rates 2 weeks, 3 weeks later based on that number, they're operating on yesterday's news to determine policy for tomorrow's economy. That's not the best way to go. You really, as an economist, should be looking forward. And I'm just not convinced that they do enough of that.
David Hunter states that the sudden rise in interest rates in April 2022 has adversely affected the market. He adds that this sudden change significantly impacted the economy and consumer confidence. With consumer confidence in the ditch and prices of commodities soaring sky high, there is a lack of activity in the economy, further slowing it down. David Hunter says that although he understands the Fed's thought process with demand destruction and inflation, he fears there could be far worse demand destruction right around the corner. David concludes by stating that the Fed could set the economy up for a hard landing. He adds that they are pretty clueless about how their policies affect the economy. The Federal Reserve indeed has a highly complex job, and not everyone will be pleased with its decisions. Their policies are currently riding on a slippery slope that could crash the economy anytime. Nonetheless, if they continue on this path, they could very well do some real damage to the US economy, which could affect millions of American consumers. What did you think of David Hunter's analysis of the Fed's actions? Do you believe that they caused this inflation we are currently experiencing? Give us your insights in the comment section down below. If you enjoyed this video, kindly like and subscribe, and we'll catch you on the next one.